Good afternoon, everybody, and welcome to the first panel discussion of the Hillary term here at the Oxford Union. My name is James Price. Thank you all so very much for joining me. Thank you to all of our panelists who will be coming to, and thank you especially to Hogan Lovells as well, who are kindly sponsoring this event. And now, without much more ado at all, I'd like to turn to our first speaker, who will be Lord Myners, the former City Minister, who I'd like to invite to give a few opening remarks on the future of the city. Lord Myners, thank you for joining us.
Mr. President, members, guests, good afternoon. Thank you very much for inviting me to participate in this discussion. My contention today will be that London will continue to be the significant financial centre in London, but it will be less dominant as time goes by. And that's possibly not a bad thing for the UK economy and society, given the dominance that we have allowed money to have over recent decades. To avoid the pedantic argument of what one means by the city, I'm not limiting it all to the square mile. The city financial services have spread regionally. We have important centres in Edinburgh, Bournemouth, Bristol, Norwich, and also in London, where the city has spread to Hoxton, Shoreditch, and Southwark. But I'm not sure, when defending the city and looking at the future, whether one can actually include FinTech within the city, because it is as much a disruptor, a force which is seeking to undermine the traditional city rather than to join the city. We've heard in the past, and may this evening hear well-rehearsed arguments about why the city is so important. Our position on the Greenwich Meridian, the English language, respect for our rule of law and our legal institutions, and our cultural openness. But technology has reduced already many of those advantages. The clustering that we've come to associate with the city is no longer important in a digital and rapid communication age. And so many people working in the city now speak English as a second language that even the language isn't necessarily an advantage which allows us to stay ahead of other European financial capitals. If we look back to the past in the city, I would start my story by the 1960s when George Boughton and Lord Cromer came together to identify, pursue, and monetize the opportunity offered by the offshore dollar market and the development of the euro dollar. And that was followed by a Trente Glorious between the mid-80s and the Brexit referendum, triggered by Big Bang, the introduction of the euro, the Lamfalussy internal market project, and a continued focus of economic power within the North Atlantic. Public policy also was positive throughout that period, and for 30 years, we had declining interest rates, which were a powerful inducement to investment in the type of instruments in which the city specializes. It's difficult to see any similar forces coming to play in the near future. Indeed, there are counter forces at work which may actually operate in the opposite direction: nationalism, populism, and increased regulation. A move to digitalization, which will undermine the importance of clusters, the growth of Asia and a focus on resilience, and a disposition increasingly towards more regulation rather than less regulation. Indeed, the days are long gone by when we've heard people advocate regulation light. I have argued at the beginning that the growth of the city is not necessarily good for our national economy. It's led to the increased dominance of London and the Southeast within our national economy and increased inequalities in the distribution of wealth, of income, and life opportunities. Before the period I've described, the 50 or so years, it's worth remembering that the city was not an international centre. There were no more international banks in London than there were in Paris. And it was with Big Bang that we saw the internationalization. Well-established Names such as James Capel, Shepherd and Chase, DeZuit and Bevan disappeared, gobbled up by international purchasers and large banks. That was the city that I originally joined. It was a city of narrow alleyways and small offices and business partnerships in which the partners had unlimited liability. We were not the international force and global power 50 years ago that we are now. If I turn to the EU, it's important to note that financial services were largely omitted from our agreement with the European Union. Why did the UK allow that to happen? I don't know, but it was clearly to the advantage and was the intention of the EU. Mairead Guinness, the European Commissioner for Finance, has made it very clear that if a state opts out of the UK, there will be consequences. The EU has made it very clear that continued dominance of the finances of the EU by a third country, the designation they now give to countries like the UK, in matters of finance will be, in her words, intolerable. This is part of a UK policy, an EU policy rather, of achieving strategic autonomy. It's very clear in finance, but we also see it in areas like life sciences and technology. In finance, the EU is going to give priority to developing the single European capital market, the freedom that has been least developed under the EU, and also on developing a centralized resolution mechanism. The forces within the EU will be for centralization of regulation, control, and direction of financial services by the EU, with the UK as a bystander. Closer to hand, we have significant problems still to face in the area of equivalence and delegation. The latter is the holy grail. It is the rule that restricts fund managers from offering services into the EU unless they operate under EU regulation or equivalent regulation. And it's where the money is managed that will ultimately determine the growth of financial centres within Europe. And let's not be muddled about this. I'm sure we in the UK would do exactly the same thing if we saw ourselves in the driving seat for European policy. This is all inevitably going to lead to a reduction in London's dominant share in things like stock trading, derivatives, and foreign exchange. But pockets of strength will continue. I think, for instance, London will continue to be the dominant market in Europe for reinsurance. And there will be areas of new opportunity, green finance, FinTech, but these are small compared with those areas of stock trading, derivatives, and foreign exchange, where I'm envisaging a loss of our dominant position. And even if we've lost the European market, we will still have increased opportunities within the emerging markets. I remember when I was on the court of the Bank of England, Andy Haldane showing us 3 global maps of the distribution of wealth from the mid part of the 19th century to the 20th century and to the 21st century. And the growth of wealth in Asia was truly stunning when you saw it on that particular map. And of course, the government has not been totally passive in seeking to address some of the problems and challenges we face in financial services. Here, I think of the review they've launched under Jonathan Hill on listing regulations, Ron Khalifa's work on FinTech, and the work of individuals supported by government like Hugh Van Steenis on green finance. But we need to be realistic. The future is going to be much more challenging than the past. I decided in the 1970s, after a brief period as a school teacher, to pursue my career in the City of London. The door was just opening to people like me coming from a social housing background and a state education. And the rewards were great. I was indeed partly inspired by the words of Bernie Kornfeld, the well-known buccaneer and financial crook, that if you want to make money, you should work with money. I think that's proved true over the last 40 years. It simply won't be the same in the future. And if I was recommending a young person now on career path, I would not be recommending the city and financial services in the same way that I chose for myself 40 years ago. Thank you very much.
My lord, thank you. Thank you very much for that. That was wonderful. And now I'd like to ask Xavier Rollet, KBE, who is the chairman of the board of Votagro PJSC, for his comments next, please.
Yes, thank you very much. I think Lord Myers is very eloquently has enunciated for us many of the salient points of the situation we're in. I'm a technician. I'm not a politician. So I look at it from a technical approach. If we look at where we've been since January 1st and the relationship between the UK and the EU, we essentially are looking at two economies. The EU is obviously larger, but they're mostly configured in the same fashion. About 75% of GDP is more or less, in both cases, accounted for by services, and about 25% by manufacturing goods as well as agricultural production. And as we stand today, we do have a deal for goods and agricultural trade in an area where the EU enjoys a large trade surplus against the UK. In services, particularly financial services, where the EU historically and still as of last year enjoyed a large trade surplus as well as invisible surplus against the EU, there is no deal. There is no agreement. And we are now facing, in my opinion, an extended period, which could easily take a decade or possibly more, even if on occasion we hear that memoranda of understanding or sort of generic political agreement to sign. In the reality is the detail of technical specifications and agreements regulating things like mutual recognition of infrastructure, financial or other service companies, the equal access, equivalence. You hear a lot of these words, which essentially mean the ability for the UK services industry and, of course, the city in London, which historically, certainly in the last 20 years, has assessed its position as the number one, the preeminent financial services center in the world under most definitions, perhaps not in every single category. But what I think we're likely to see, certainly at least in the coming decade, is protracted negotiation, which will not be facilitated by the relatively toxic environment between the UK as a sovereign nation and the EU. Let's say, by the way, that the EU is not a sovereign power. It is not recognized as such. It does not meet the legal definition of a sovereign power. And in fact, it's not even recognized as such by its own members, the treaty association. But putting that aside, the environment clearly is going to be complicated by the growing toxicity of the relationship between the two. So how is the City of London likely to fare in that respect? In my view, its core strength will remain. We've heard from Lord Myers what some of those were, but I think its position is definitely at risk. And as regards financial services in particular, which is perhaps my own area of expertise, I would make one point. One of the areas that I'm going to be, and that I would suggest, is looked at with a great deal of attention if one wants to kind of guess the direction of travel of the relative importance of London, is going to be the clearing of OTC derivatives. And why is that? Because London, first of all, it is an infrastructure business. And one of the benefits and the reasons why London has achieved that global dominance that I think is undeniable in a range of services is because a lot of the global, not just sterling, UK or European, but a lot of the global infrastructure in financial services is run here in the UK, in London, by London-based infrastructure companies. I mentioned the OTC derivatives market. Over 90% of the global market in OTC derivatives, which is the largest financial asset class in the world, bar none. Certainly in terms of notional value, far exceeds $1 quadrillion. Over 90% of the global market, including Canadian dollar, US dollar, Mexican pesos, of course, sterling and euro, but also Japanese yen and a range of G20 Asian currencies are cleared here in London. And the approach of the EU, and I continue to hear this very much in the corridors of European treasuries, whether it's in Berlin or Paris, is not going to be, I fear, to agree to a long-term equivalency or mutual recognition of clearinghouses as regards that particular asset class. I am pretty certain that although this will take some years, they will in the end seek the forced repatriation through regulation of that particular asset class. Does this mean that everything is going to go? No, but if that bit goes, likely the position of London, as been quoted, not always accurately in the past, the position of London as the global center of risk management for this extremely valuable particular asset class will eventually shift not to the EU, but to the United States. And I think one element we need to keep in mind is that as part of these, no doubt, protracted negotiations across a whole range of financial services and other services, is that the United States enjoys for these areas of financial infrastructure, currently does and is likely to continue to do so in the future, mutual recognition, as well as equivalent access with the EU. So the UK is today faced with a particular dilemma, which of course will be for policymakers to resolve. Will it seek to maintain equivalency, not just today, but in the future with EU standards, particularly as regards the prudential management of these critical areas of financial infrastructure, which underpin the presence of many upstream and downstream functions, whether it's treasury, underwriting, sales, corporate services. There's hundreds of thousands of jobs that are connected technically to the presence of these services. So will the EU be successful in forcing the repatriation of EU-denominated, euro-denominated services, particularly in the area of clearing, at a time where less than 25% of euro-denominated flows in these critical and strategic product areas actually originate from outside the EU, and likely the main beneficiary, given the maintenance of that mutual recognition, if some of the business shifts out of London, will be the United States, because the United States, for a simple reason, which is technically easy to understand, will be able to offer continued global compression, netting benefits, or liquidity services involving, and that is the utmost strength of London as a global financial center, involving global currencies. And today, the reason why the big banks and the big asset managers come to London, the London Clearinghouse, for example, is because you can compress your Canadian dollar, US dollar, euro, sterling, the Japanese yen risk, as well as a range of other Asian currencies. If an element of that shifts, then the competitive dynamics likely will move out of the UK. This is unlikely to happen overnight, but it certainly is at this time my understanding that the EU strategy is to repatriate at least a portion of those businesses through regulation to its own shores. And this is not just an economic argument. This would actually be detrimental to the financial interest and the bottom line of EU-based banks, as well as asset management companies. But one thing that needs to be remembered is the Brexit decision has been interpreted for what it is in the EU, as a political decision. It's therefore unlikely that the EU is ever going to give to a political challenge an economic answer. And so I would be, amongst other things, looking at the future over the coming years of that particular vital part of financial infrastructure, Unfortunately, the trend at the moment is not too favorable. I was reading a recent report from OTC Trade, and I think it was IHS Market Serve, already identifying some of the things that, in fact, many, including myself, have been saying for the last 4 or 5 years, that the migration to US shores of a fairly important amount of OTC derivative transactions to swap execution facilities, which are US-based entities, has already started. So in my view, there is a risk. The UK is faced with either the maintenance of equivalence with the EU and essentially continuing to maintain that equivalency also with the US, but thus maintaining a fairly uncompetitive set of regulation in the global markets. Or, of course, recalibrating its regulatory and fiscal regime to make it more attractive, but then giving the EU a golden argument to essentially stop that equivalency. And I will conclude with this point. These are pre-COVID statistics. They may have changed somewhat with the abundant issuance of government debt in the last 10 months or so. But at the end of 2019, prior to the COVID pandemic, 55% of global financial assets were US owned, and about 18% were Chinese owned. And this trend is unlikely to be reversed. In fact, China, on the back of its economic recovery, is likely to take an ever increasing share of the global ownership of financial assets. So we should also consider, in the context of what will the city do, what will happen to the city, what will China do? Will China liberalize its equity markets? Will it privatize its exchanges, its clearinghouse, and seek to achieve a major competitive position in global markets? Or will it retrench under a sort of European model, which essentially mandates that policymakers ultimately are going to control the mechanisms of distribution of capital through a corporate funding system, which is essentially driven by bank lending? And depending on that decision, I think a potential competitive threat or opportunity will emerge for the City of London. Thank you.
Xavier, thank you very much for that. Before I come on to our next speaker, I just like to remind everybody in the audience that if they look at the bottom of their screen, they can see the Q&A function. And please do start getting your questions in now that I'll be able to put to our panel once the remarks are done. And speaking of those remarks, I'd now like very much to ask Charlotte CROSSWELL, who is the CEO of Innovate Finance, to give her remarks. Charlotte, thank you.
Great. Thank you very much, President, and thank you for inviting me today. Perhaps I can look at this from a new way, a new city. Finance is changing. This isn't the banks going away. This is the banks changing and evolving and innovating. This obviously started post 2008 crisis, where we saw the birth of FinTech. We saw suddenly tech startups appearing around Old Street. In 2010, there were 85 of those. In 2011, there were 200. By 2015, there were 5,000. And what that's done is, as Lord Minor said, is it's innovating, it's perhaps disrupting, and it's bringing some of those solutions to a tech-hungry consumer. But how is this actually changing the way we do financial services, and what does that mean for the future of the city? Banks and investors have been drawn in by this innovation. When we look at the FinTech sector, and just last year, even in COVID and even on Zoom deals, which were incredibly hard the first half of the year, we saw over $4 billion come into the FinTech sector to fuel the UK and its growth. Half of that came from overseas investors. And that wasn't just deals started pre-COVID. In fact, H2 of last year was up 76% on H2 of 2019. For those who are concerned about Brexit, and I think we're all concerned about what that's actually going to impact to financial services, it's certainly not putting off people by coming to invest into this new sector that we're seeing out of FinTech. There's disruption, but disruption is actually leading to partnerships as well. About approximately half of our FinTech sector is regulated, and the other half are there providing tech-enabled financial services, talking to banks, B2B, B2B2C, as well as straight to the neobanks and challenger banks and the e-commerce that we've seen. So where we leave the last crisis and we come into this crisis is we were just at the end of that phase one. We had these niche products, some of the fintechs, and you will know many of these household names now are going into millions of customers globally. The regulators trying to keep up. They started with the sandbox, which has been copied around the world, and now is the envy of everybody. And everyone looks to the UK for that leadership. We actually see regulators and government and industry sitting around a table. When we look at those US markets, it's very rare you will see anybody around a regulatory table unless they're talking about being regulated. And what that's meaning is we're constantly feeding into the evolution of this important market for the UK. What it's meaning is banks from overseas are wanting to put some of their banks into the UK that aren't here already because they want to learn from the innovation that's coming through and sit alongside those fintech companies. Maybe they're going to buy them, maybe they're going to partner with them, but certainly what they're going to do is innovate themselves. In terms of jobs, it's very difficult to estimate what this meant in terms of jobs for fintech. The last time we had a census done, which was in 2017, it was just over 75,000 jobs created in fintech, but that doesn't take into account firms like WorldPay, which are thousands of jobs in itself. When we talk to banks, I'll give you an example of Barclays. 90,000 people go through the Barclays Rise sites every single year to learn about innovation. So we must be careful not to see fintechs and the Shoreditch analogy, looking at that as that versus the banks. We now must look at this to how to innovate our financial services sectors, how to continue to be the envy of the world on such an important sector. COVID has proved a real pivot point for innovation in FS. Suddenly we had call centers decimated, banks desperately trying to continue their businesses and doing a pretty good job, I think we can all say, by leveraging the best of technology there was. Fintechs transitioned obviously seamlessly, but nobody was really using fintechs as the core. Siebel's loans at the beginning of that period were all put through the banks because we used a scheme that had come out of 2008. And suddenly fintechs who were in SME lending recognized the opportunity they had to prove what they could do to government, to regulators, and to SMEs themselves. We've already seen SME financing move about 30% away from high street banks since the last crisis. Even in the first few months of the crisis, one fintech alone was responsible for 25% of Siebel's loans distribution. And that had taken them 6 weeks to get accredited in order to be able to distribute those. In terms of challenger banks, they gained more customers every single day. In the first month of the crisis, 6 million working adults across the population downloaded an online banking app for the first time. And suddenly their relationship with banking has changed forever. We're not going to see that go back. Then people who've had the best online service, the best customer experience are going to win out. They said this isn't challenger banks versus payments companies. This is the change of a whole ecosystem. And now what we have that opportunity is to learn from what we've done during COVID, to learn where the millennials, where the end consumer wants to see their relationship with financial services, and then let's build that momentum up. There are no doubt challenges ahead though. This is a sector that requires many digital skills. We don't have the talent to fulfill that because we're in a global race for talent across the world. And I echo the point about the global city that we live in London, but even up and down the country as well, as we've seen so many universities look at this innovation and bring people through that and start to solve some of these financial services solutions. So over 40% of the fintech sector is not from the UK. Many of those have started within our education system. 28% is from the EU. So we have to be careful to protect that talent that we have acquired and make sure this is still an attractive place to come and work, and that we bring that talent in to fuel the fastest growth companies. And there are already talks about some of these fintechs putting teams outside of the UK because it's just too difficult to get through the visa system. So definitely some challenges ahead, but things we can certainly address. 18 months ago, we talked with Treasury and said as a result of where we were already seeing innovations as pre-COVID, we felt that it was time to do a review of the fintech sector. And Lord Minus has already talked about the Khalifa review. Ron Khalifa was CEO of WorldPay. He's been through this. He's very, very well experienced in how to look at this. And he has spent the last 8 months working through about 300 bilateral meetings, roundtables, conversations with government regulators, overseas hubs, to really see how we can take on this momentum we've built and then use it to transform the consumer and the business experience up and down the UK. He's looked at that from a skills and talent perspective, how we fuel the talent, how do we change our talent of the future, and how do university courses need to change to adapt to this new demand. He's looked at it from a capital and investment chapter. How can we take a company not just from Series A investment and then a quick exit, and we saw a lot of this happen in the tech days in the late 90s, but how do we grow and scale that company all the way up to IPO? And yes, we do want those IPOs in London. And I'm delighted that Jonathan Hill is leading that review, because it is time that we modernise that exchange and allow founder-led businesses to access public capital here in the UK, and give that upside for some of our investors to see that we've seen in the US with their tech stocks. Ron has also looked at it from a national connectivity perspective. FinTech was a London story because it started in Silicon Roundabout, it moved to Canary Wharf, it's now through every part of the ecosystem there, and jobs are springing up all over the place. We're seeing FinTech Wales, FinTech Scotland, FinTech North, FinTech West continue to emerge. And one of the fun facts I've discovered during the review is there's more jobs in Scotland in FinTech than there are in the fishing industry in Scotland. So not a sector to be ignored. Regulation and policy, and I know that Rachel is going to be speaking shortly, is an incredibly important part of our evolution of this nascent sector. The sandbox, as I said, has been copied around the world, but now we need to support our companies in their scaling as they gain millions of customers, make sure they have the compliance and the governance support, and we push them to have the highest standards of governance while not stifling innovation by treating them like a bank. So it's proportionate regulation. That's not necessarily less regulation. It's proportionate to where they are in that growth cycle and making sure we are supporting them. And then we finally have to look at the international attractiveness and competitiveness of our city. During the review, we've looked around the world at what's done in the best places. We've looked at Singapore, MAS, where everything is very aligned between industry, government and regulators. We've looked at Australia, who has a FinTech minister, and we've looked at the US and the opportunities for the Financial Innovation Partnership. Other countries are trying to emulate the UK. They're trying to catch up. We still have that head start. We are very much seen as a global leader in this. And that's why new banks are coming to the UK to learn from that. And that's why new funds are investing into UK FinTech. But we have to challenge ourselves to stay ahead, because it is a sector that has so much potential. That potential comes into its own as we start to look at economic recovery, whether that's SME financing, looking to finance new businesses that are looking to start, whether it's allowing us to have that digital transformation, whether it's the banks themselves and more frequently now asset managers and insurers looking to build their products from data upwards, not just building more efficient banking services. We have this huge opportunity to embrace that. We must look at helping the poorest in society with FinTech, whether that's credit scores, whether it's making sure that we don't allow people to go back to payday lenders as they face unemployment. Maybe they use a salary advancement scheme instead. But we have this potential up and down the country to be leveraging the best of that, looking at financial inclusion, looking at the jobs opportunity we've had, and most importantly, looking at our opportunities for global trade as we take these companies from these small FinTech disruptors all the way through to the partners in financial services and are some of our global champions of the future. Thank you.
Charlotte, thank you so much for that. That was wonderful. Can I now please ask Rachel Kent, the partner at Hogan & Lovells, for her thoughts? And once again, thank you to Hogan & Lovells for generously supporting this event.
Thank you. And thank you, Charlotte. And I have to say, the 20,000 roundtables and one-to-ones and bilaterals with Ron were absolutely worth it. Perhaps it only felt like 20,000. Good evening, everybody. Thank you, President. Hello, fellow panelists. Nice to see you again, and hello, everybody. Lord Minor's had a contention, and so I've been thinking, if I had to have a contention, what would it be? And I think it is that if we are facing something, it might not be an existential crisis, but it is certainly an existential issue. So what do I mean by that? Any business knows that access to markets is absolutely vital. And of course, the problem for financial institutions in relation to Brexit was the loss of passporting. We all know passporting allows you to use your authorization in one jurisdiction and passport that around the other 27 without obtaining a new license. That's worth a lot, real cash. That's what drives efficient business models. It's well worth having. For that reason, after the referendum, a number of us from the city spent a very long time in Brussels and in the EU 27 capitals asking the EU for a very close relationship, which would involve something like passporting. I think that that's what Xavier Rollet meant by mutual recognition. That was certainly our proposal. In return for such a deal, we accepted that some degree of alignment with EU law would be necessary. That was the price we were considering for that access. Well, we didn't get that deal, although I note in passing that if you read the FT this morning, you will have seen that Andreas Dombrat, who is on the board of both the ECB and the Bundesbank, was actually proposing that such a model of much closer alignment, a strong and close bilateral agreement, was infinitely preferable to equivalence. But in the EU, there is equivalence, and that also requires alignment. And it has to be said that the deal that was done on Christmas Eve, the Trade and Cooperation Agreement, the joint declaration that goes with it, or even the MOU we are still hopeful of getting, none of those have given or will give us equivalence. We are waiting for the EU to make that determination. They have, of course, as we already know, told us that at the moment they're not giving it to us because they are concerned that we might diverge back to the issue of alignment. I also note in passing there that the UK has, of course, granted the EU equivalent. I also note that our own Chancellor, Rishi Sunak, said in his City AM podcast a few weeks ago that he thought we were looking at Big Bang 2.0. So again, I go back to Lord Miners, he mentioned the first Big Bang. Maybe we've come full circle and maybe we are facing something equally disruptive in a good way again. Rishi Sunak also mentioned diverging, as he put it, a little bit from the EU. It's no doubt that that is at least part of the reason why the EU are concerned about the UK's plan. So back to the existential issue. I really think the issue facing us now is access to the EU market still worth that degree of alignment? Or should we be exercising what you might describe as our lawmaking muscle, claim back the sovereignty we obtained on Brexit to go our own way? So maybe the future is China, maybe the future is the US, or maybe, as Charlotte says, the future is Khalifa. I certainly hope it is. But I do think that until we've answered that question, it's actually quite difficult to know what the future holds for London. Thank you.
So thank you very much for that. There's lots of open questions there, which is wonderful for people in the audience to come up with some questions of their own. They can steal some of the ones that you posited, and that's just to remind people that they can ask questions in the Q&A section. I'd now like to ask DLA Piper, a partner and alderman in the City of London, Vincent KEAVENY, to give some remarks. And Vincent, I was wondering if perhaps you could just, 20 seconds, explain what it is to be an alderman in the city and the kind of arcane processes of the city to our members.
Well, thank you very much, President. I tend to say when somebody asks me to do that, I tend to say when I finally discover what it is myself, I'll let you know. But in essence, an alderman is an elected member of the City of London Corporation. Each of the wards in the city elects one alderman and a certain number of councillors. The office of Lord Mayor is drawn from the alderman of the City of London. To be Lord Mayor of the City of London, you have to be elected as an alderman and have served a year as one of the two sheriffs of the City of London. I served as sheriff in 2018-2019. And I'm currently what's called senior alderman below the chair. So all being well, I will be elected Lord Mayor a little bit later this year. I've supported my fellow aldermen for election as Lord Mayor later this year. As you say, I'm a DLA Piper partner as well. And I'd like to start perhaps just by broadening out, just talking a little bit about the physical city, the square mile. And I say that with some caution because, of course, in the City of London Corporation, we and the Office of Lord Mayor, there is always an emphasis on speaking on behalf of the financial, professional and tech sectors of the UK as a whole. But I think in the context of the discussions we're having, it's interesting to look a little bit at the physical city, the square mile itself. And in that context, just thinking a little bit about Lord Minor's comments at the start of the discussion about where to draw the line around the city, and indeed when to think about when did the city that we know really start. And I think we've got to look a bit further back in time. Certainly the Eurobond market, Big Bang, all of these things are very significant. But the city has had an international standing at the heart of the commercial world for centuries. Lombard Street, named after the bankers of Lombardy, who had their palaces there, which they provided banking across Europe. The Steel Yard, where Cannon Street Station now stands, in the 15th century, the headquarters of the Hanseatic League, or Nathan Mayer Rothschild leaning up against the pillar in the Royal Exchange in the early 1800s, from which he financed the governments of Europe, and indeed, truth is, if the story is told, made a killing on the early receipt of news of the outcome of the Battle of Waterloo. So we are at a particular point in time, and Charlotte, I think, has identified some of the factors that are of change that we need to keep that are very relevant to the current situation. But this is a historical continuum of change, and the city has lived through periods of great change before. One of the changes, of course, we're dealing with is the pandemic and the effect that has on our working lives. Interestingly, I've had a very particular experience of that at DLA over the last 7 or 8 months. We had a seamless transition, as most professional services did, to the virtual world. But there is a missing element to that. And it was interesting last July and August, led by the partners, and asking our trainees and our junior lawyers to return. But by early September, we had about 50% of our 900 or so strong London office back in the office regularly. In fact, we were running a waiting list at that time for people to come back in because we reached, on a social distance basis, we reached capacity. I've been supervising a trainee over the last 6 months for the first time in several years. One of the reasons I've been doing that is we were able to coordinate our visits to the office over September, October, into November, to make sure that those one-to-one conversations that you can't replace in the online world were actually happening. Myself and Nicole, my trainee. So I think from a physical city point of view, there is the importance of place remains very strong indeed. And what has the corporation been doing about that? Well, in October, the corporation published a report which was co-authored with Oliver Wyman, called London Recharged, looking at how London will remain globally competitive in the financial and professional services sector post-COVID into the mid-2020s. Key messages from that report: the resilience of the sectors, the fact that the digital adoption has been so successful. The slow return to work in itself is evidence of that digital resilience. Businesses, however, the message is very strong. Businesses are committed to a major central London presence, the central business district that the City of London will represent, and the value that agglomeration, that clustering effect will provide. London, I have no doubt, will still be the place to innovate and collaborate for some of the reasons that Charlotte touched on when she was speaking a moment ago. There's a huge role as well for London in supporting the rest of the UK's recovery, and businesses are committed to doing that. So both nationally and globally, there is a real opportunity in this time of change for London to emerge as, we would say, the undisputed place to innovate and collaborate, to bring new ideas to life. So building on the London Recharged report, we have set up, the corporation has set up a recovery task force, which is consulting just at this very moment on the first cut of an action plan, a 5-year blueprint to ensure that the Square Mile remains the world's most innovative, inclusive and sustainable business ecosystem, an attractive place to work, invest, live and visit. And each of those components is important, very important to the overall picture. There's 4 focuses in this work. The first is outstanding environments, making sure that we have the right workplaces for the future, the right environment, the right infrastructure. And an example of that is the building, the planning permission that was granted just last week in the city for 55 Grace Street, where Tenacity, a Hong Kong developer, is replacing a rather tired 9-story building with a 33-story building. Interestingly, that 33-story building, significantly larger, will use 25% of the electricity that the current building uses. A much greener, much more sustainable building. It's buildings like that that we're going to be seeing coming on stream in the city in years to come. Alongside outstanding environments, we're looking at the business ecosystem, looking at the opportunities to create the connections in the areas for innovation and growth, looking at our world leadership position in areas like green finance, FinTech, AI, and the creative industries. And I'll come back to that in a moment. But alongside those two things, a vibrant offer of retail, making sure we get the retail back up in hospitality, culture, heritage, tourism, all of those fantastic assets we have that make working and living in the city a special thing. And people, and we've touched on already the skills challenge, the digital skills challenge, the wider financial services skills challenge, making sure we get the best people coming in, but as importantly, making sure we have people being trained here in the UK in those skills, and that we're also addressing some of the social mobility issues that are real blockages to the best people coming through. Alongside all of that, the Lord Mayor, William Russell, has been leading a culture and commerce task force, bringing together business and cultural leaders to address the particular challenges faced by the culture sector. And there's a report on that being launched on Tuesday with some very exciting ideas, which I won't preempt here, but any of you who are interested in that intersection between culture and commerce, look out for Tuesday's launch report. And finally, running through all of this, our response in the climate sector, because I think it's important to bear in mind that alongside all these existential challenges that we are facing in the financial services world, we are facing a truly existential challenge in the climate field, which is of course one of the great focuses and opportunities of the year ahead, with COP26 coming along. The city of the corporation adopted last October its own climate action plan. A lot of other cities around the world have declared climate emergencies. London is the first city where we've adopted a funded climate action plan. It is funded to the tune of 68 million for the first 6 years. That aims to achieve, in terms of the corporation's own operations, zero carbon emissions by 2027. And if you look at the wider the carbon emissions across investments and supply, the supply chain, zero emissions by 2040. And in fact, we're building around the corporation's own activities the ambition that the entire square mile will be net zero by 2040. So, and all of these other pieces of work I've referred to, all of these other pieces of work have that climate action thread running through them, so that we don't lose sight of that. So I think it's a very exciting time. I'm very optimistic both about the physical square mile and the future of the physical city, but within that, the great innovation, the growth, the energy and the ideas that will come, that will allow us to overcome some of the very difficult regulatory challenges that we're facing at the moment, and that it will continue, as it has for centuries, to be a place where commerce thrives. Thank you, Mr. President.
Alderman KEAVENY, Vincent, thank you very much indeed for that. In just a few moments, I'm going to ask Charles Lewington, the CEO of Hanover Communications, to give his thoughts. And then afterwards, and this is just a reminder to our panelists, I'll be going through each of you again just to ask for any thoughts you may have on the other kind of remarks that you've thought in there, in an attempt to try and make this feel a little bit more like a real life roundtable of the kind that we've all been missing for the last year or so. And before we get onto that, I would then like to ask Charles Lewington, the CEO of Hanover Communications, for his thoughts.
Thank you, Mr. President. It's a fantastic honour to be talking to the Oxford Union today, and even more humbling to be following quite such a distinguished panel. Let me start by explaining where I come from in this debate. I'm a business optimist. Of course, any business leader needs to spend a lot of time examining the challenges, managing risk. But at the end of the day, you don't grow a business unless you seize the opportunities. And I think this is what the City of London will do, because it's more than capable of doing it. I voted Remain, but we are now out of the European Union for good, and believe passionately that the City of London must now look beyond Europe. It's not that EU membership hasn't been fantastic for the city, but as others have said, our main competitors are New York and Shanghai and Singapore. As a public affairs consultant for over 20 years, both here and in Brussels, I have watched the slow pace and complex shape of EU regulation, not just of financial institutions. Sadly, the European rules, while they tend to favour big businesses, because it's the big businesses that can afford the implementation cost, but they also then discriminate against smaller innovators, scale-ups, the businesses of the future. In the debate also over comparative advantage between ourselves and the European Union, we've tended to overlook the real flexibility of labour markets in the UK. And I remember watching quite closely the charm offensive that Paris and Amsterdam and Frankfurt mounted on London about 2 years ago now, with lavish hospitality and offers of discounted office space. Even those bankers who are attracted to Frankfurt over Paris because of the rigidity of French employment laws soon discovered that German employment laws were as rigid as French. According to Ernst & Young, the final tally of London jobs that shifted abroad was 7,500, which represents about 0.7% of the city workforce, despite the Financial Times at the time warning of an exodus of about 100,000 jobs. The city is loosely described as an ecosystem of world-beating investment managers, bankers, lawyers, fund managers, corporate advisors, environmental and governance consultants, all the people that are needed to oil the wheels of capitalism that pays for our public services. They're going nowhere. And finally, I just talking about my own business, it's a decent size. It's about 175 consultants. But as an entrepreneur, I have come to realize that we need disruption because it drives innovation. Disruption should be embraced as a force for good, not ill. I find the media and political debate about the future of the city depressingly sterile, even among financial commentators who can't disguise their Remain or their Brexit political positions. Some say we should have a low tax, low regulation Singapore of Europe, but after the pandemic, we can't actually afford to lower corporate taxation further. And of course, too little regulation exposes the retail investor to risk. Others will say we should turn our backs on Europe since Frankfurt and Paris are 16th and 17th respectively in the Economist Intelligence Unit ranking of global financial centres, and we're second and closing the gap on New York. But the big four EU economies represent 9.5 trillion pounds of GDP. That's 3.5 times our own GDP. And our capital markets will still be needed to service those European companies. There's also the sort of pure and slightly ridiculous Brexiteer argument that I heard during the referendum campaign that we don't need the JP Morgans and the Goldman Sachses of this world. We should concentrate on investing on real jobs in the north of England. But who would pay for that investment? Since 10% of UK corporate taxation is provided by the City of London, that's £75 billion a year. And as Lord Miners will know, much of the modernisation of the schools and hospitals of the noughties couldn't have happened without the success of the city. So here's how I think the City of London will continue to grow in stature in a different shape, with or without equivalence, with EU regulation. Firstly, the idea of the 1980s Big Bang is unlikely to materialise. The EU, for all its faults, does not have the equivalent of the Restrictive Practices Act that was swept away by the then Chancellor of the Exchequer, Nigel Lawson. However, the 1980s did open up the city to the world, injecting competition into what some people would have described as a cosy establishment club. Leaving the EU will have the same positive and dynamic impact. We don't need a bonfire of regulation. I don't know what that means anyway, but we don't need it. But we can use the opportunity, if we don't get granted equivalence by the European Union, to take a blowtorch to the more onerous bits of EU regs. MiFID II, for example, which imposes disproportionate cost on insurance and life companies, and the Basel capital requirements that make it harder for challenger banks to compete with the big players. I expect you, many of you use Starling, Monzo for student budgeting or Revolut. We should be doing what we can to sustain them, as one or two of them may not survive the pandemic. We also need to reform city regulation and stop gold plating, a great British civil service trade, and continue to craft a new dynamic regulatory model. And the sandbox is a great start, I think. Finally, for those of you pondering your career choices, the world of finance is changing unbelievably fast, as Charlotte set out, I thought, very clearly. I don't know whether this is true, but I'm often told that 9 of the 10 of the UK's tech unicorns are FinTech. The sought-after jobs on this year's graduate recruitment circuit are for data engineering, product management, machine learning consultants. To compete against New York and Singapore in financial services, the UK will need to have world-beating data analyst capabilities. Singapore is arguably ahead in the FinTech race, but we won't catch up, I don't think, going at the EU's pace. I talked to a London-based US investment banker yesterday to ask, how concerned are you that the city won't get an equivalence deal with the EU? And he replied, equivalence? We've moved on from that some time ago. The world is changing incredibly fast, and the future of the City of London will be incredibly rosy if we move fast too. Thank you, Mr. President.
Charles, thank you very much indeed for that. Thank you, everybody, for some wonderful opening remarks and everything ranging across the city from its wonderful past and hopefully into a wonderful future. I'd like to just give the opportunity briefly, as I say, to try and make this something more of a real-life panel, to ask just for a sort of minute each for the panelists to comment on the things they've heard before we go to questions. So if I could ask Lord Miners, is there anything in particular that you'd like to comment on that you disagree with in any of the sort of the speeches that you've heard so far?
Well, listening to Charles, whilst I'm putting forward a contention that the City of London will become less dominant in Europe, I repeat, I still think it will be the leading financial centre in Europe. And I'm absolutely not opposed in any way to any form of disruption. Indeed, many of my businesses are disruptors, and disruption has been part of the story forever in terms of what has been happening in the city, both back as far as I went with the creation of the Eurodollar market, or VINCENT going back even further. I just don't think that our disruptive talents will necessarily ensure that we retain our current dominance in those very important markets that I identified. I'd be interested to hear from Xavier, because he's so listened to by governments here and Europe, and why in the negotiations, Xavier, the UK didn't really make any case at all for services and financial services to be covered in our agreement with the EU, because, as you say, it's very clear that the EU's dominant surplus in trade meant that they clearly had an interest in ensuring that trade continued unhampered by the agreement with the EU, whereas we're currently in a status at the moment of not having any real clarity about how we will trade with Europe in the future as far as financial services are concerned. And Charles may have met a banker who said it really doesn't matter, equivalence is yesterday's story. I don't think it is. Much of our business is and will continue to be conducted with Europe, and there's uncertainty there unless we understand what the rules of equivalence are, or indeed what the costs are of deciding that equivalence is not a good goal to have. And the EU again is playing its cards very well there, because they're essentially saying we're not going to start the equivalence debate until you tell us what you want, and what Rishi Sunak meant when he talked about some small differences around equivalence. And finally, Charlotte, you talked about FinTech banks not being hampered by regulation that was developed for banks. I'm very interested to know what that means in practice. I think if you conduct banking activities such as the transference of money, the taking of deposits, the offering of securities, then surely whether it's done through FinTech or any other institution, it should be regulated on a common basis.
Thank you. Well, the next person I'm going to ask on for some thoughts is Xavier, and so maybe I can start with asking you to answer that question. You know, why is it that perhaps the UK didn't go for this sort of this work in services, and maybe some other thoughts you had on the other speeches as well, please.
Right. Thank you, Paul Miners, Lord Miners, and thank you, sir. Maybe an interesting story will give part of the game away as regards the EU. Only 2 days after the outcome of the referendum was known in June 16 in the UK, the French president at the time, François Hollande, who had campaigned and obviously had been elected with the following theme: finance is my enemy, and obviously being elected, not 2 days after the outcome of the referendum, made a nationally televised speech claiming, again, this is a man who said finance is my enemy, claiming the clearing of euro-denominated OTC derivatives, an arcane, although massive, financial asset class, but certainly arcane to most people and certainly most politicians in France, claiming this back not only for the EU, but for Paris. And there's clearly, and we've seen that, and by the way, the impact on the city, it's too early to tell. Brexit is 1 month old. We've certainly seen a delay in many investments in core infrastructure. And I'll get to innovation in a second, because I do think that is the solution, but there's one big caveat. But there clearly is an attempt, and it will be a continued attempt, which is why I think it will take many, many years to ultimately succeed in getting some form of, again, not MOUs, but technical agreement, branch by branch, sector by sector, as to what the UK and the EU are willing to give to each other in terms of any mutual recognition, equivalency, passporting. There are nuances about that. But they want it back. They have not been able to secure these businesses because ultimately their economies are not run in a competitive fashion, which was something that was driving and had been driving the UK for many decades. So no one will argue that most of the regulations coming out of the EU, as far as financial services and many other areas, were geared to be competitive and establish a competitive position. I would also highlight the fact that the overwhelming majority of EU financial securities drafting that came out of ESMA or its predecessors were essentially drafted by folks from the FCA or the FSA at the time, who enjoyed an outsized influence in terms of the College of Regulators. Now, that's obviously gone, but I agree with the comment that was made that the notion that the UK is going to hastily deregulate, in my experience, doesn't jive with the principles, the philosophy of UK regulators, and for a range of good reasons. So there are some issues, and I think a political will in the EU to recapture that business. And from what I continue to hear today, I don't think there's any way, and perhaps this is the meaning of the comment from the bankers that Charles was talking to, that the EU is ever going to accept long-term, I'm not talking about short-term extensions or meaningless MOUs that are not binding or are just headline political agreements, but long-term technical equivalency. I don't think that's going to happen. And I think wisely, the UK government realized that, they were probably told so, and figured, okay, what are the other things we can get? Because this is not going to happen. Which leads us to the second part of today's discussion, which is the relevant one, which we've heard very eloquently from Charlotte and from Vincent, which is the UK has by far the largest pool of SMEs, putting COVID aside and its temporary impact. But going into COVID, the UK had 5.4 million SMEs. That's twice the amount of SMEs that Germany or France had. And that is the key, that the ability of the UK to match an entrepreneurial population, whether it's made of Brits or international people that have come here, to match them with its university, world-class university system, and to produce very, very attractive, successful startups. The UK has been innovating, and the numbers are there compared to Europe. There's simply no comparison. It is certainly a matter of envy. But if you're going to be contemplating, again, because the dynamic is not sterling euro, the dynamic is G20. If because of the absence of mutual recognition or passporting or equivalence, whatever that particular branch of the financial services industry requires, if you're looking at losing that, which is what I think will happen, I think the banker, probably a US banker, said was correct, then some very big chunks of financial services, infrastructure services that ultimately underpin the existence of many services, upstream and downstreams, are at risk. And again, at risk of moving to the United States. So how do you preempt that? And I do agree that innovation, SMEs, startups, matching the research and technological acumen of world-class universities with an entrepreneurial population is the key to replacing that, perhaps even exceeding it. But there is one big caveat, in my humble opinion. I've been quoted in the press many times over the past few years. In my humble opinion, the regulatory framework as well as the fiscal framework that we have today in the UK has not supported the creation or promotion of very deep, liquid equity markets to successfully scale up those businesses. And I think the opportunity today, I certainly welcome the Lord Hill's review and many other reviews that have been done before. They've never been acted upon. I hope, given the circumstances, this one will. There is some urgent recalibration of the regulatory framework, but also the fiscal framework. We talk about retail participation. Retail participation is, in the UK market, the lowest in Europe because of the fiscal pressure of the financial transaction tax, the 0.5% stamp duty. And there's a range of other regulatory issues. Solvency II. Solvency II that has essentially forced insurance companies and pension funds, long-term holders of liquidity, to short the real economy. Why have $85 billion of equity SPACs been issued in the US last year? $25 billion since January 1st, again in the US, some of which are going to go back and invest in the EU. So there's an urgent recalibration that hopefully will be done in the UK to substantially deepen the amount of private and listed equity that is available to these entrepreneurs to scale them up into global company. We're still today losing way too many to the US market. And this, I have to say, has nothing to do with the stock exchange. The stock exchange does not control or make its own rules, listing rules, is also subject to fiscal as well as regulatory decisions impacting pension funds. The equity pool is underdeveloped in relation to the size of the economy, certainly compared to the United States. I think that's a huge opportunity. I think if policymakers, together with the NGOs, Charlotte represents one of them, Lord Miners is highly experienced, and many others, I think the City Corporation has a huge role to play. If that can be actioned, and this need not put in danger particular branches of sectoral equivalency negotiations with the EU. But if that can be actioned, the future can be very bright. Otherwise, it will be more challenging.
Thank you very much. Charlotte, the question was put to you by Lord Miners about what kind of FinTech regulations they've been hampered by, the design for banks. And maybe you'd like to talk about that. And I know in the interest of time as well, I've got some questions coming through from people watching. You've also said that you're happy to answer this question live from Francesco Coppola, who's asking how we can use how London and the city can use the COVID crisis to differentiate itself from other financial centres.
Thank you. I mean, I think just coming back on Lord Minor's point is that we are going to have to take some risks in helping these companies scale. And coming back to Xavier, what he was saying there, and what that means is that ultimately we have to protect consumers. I welcomed the Willard Review yesterday on the regulation of buy now, pay later. So we were concerned about how many millennials were taking out these buy now, pay later loans across multiple providers, not knowing exactly how much debt they had out there. So this isn't about not protecting consumers, but also there are some people who have a bank account and they have multiple bank accounts, and allowing those companies to grow and scale, or ultimately ensuring that people can still get access to their money. And obviously we have the FSCS for banks, whichever size they are, is incredibly important. In the US, we let banks fail. It's done much more frequently, and therefore the competition and the barrier to entry is a little easier. But it's about finding that regulatory pinpoint. And on the flip side of it, we're seeing companies getting regulated with maybe 300, 400,000 potential customers at the beginning, and a year later they have 5 million customers and the regulation hasn't changed. So it's about finding that balance and making sure that there are alternatives. And we saw this in MiFID II with MTFs and exchanges. We found that balance with different licensing points depending who the sophisticated, whether it's sophisticated investor, end consumer, man on the street, etc. It's finding that way through. In terms of COVID crisis, I will come back to the levelling up agenda and the building back better. We've always talked about London being the financial services story, but very few people on the street know that 2/3 of financial services jobs are outside the M25. And we have this opportunity through this digital transformation and technology adoption to then reach out to those people to understand how they want to interact with financial services. This is either unbanked, this is underbanked, but it's also people who have debt that could be refinanced, but they just don't know how to do it, and the tools aren't available to them. So the financial inclusion agenda is very, very wide. We suddenly have pinpointed the opportunities for a technology interface with financial services, but we don't have a digital ID. And we're going to have to really think about whether we want to take some of those pieces forward. There are task forces now looking at that to say how can we ensure that the poorest in society, the people who don't even have access to the internet, maybe they have access to a smartphone, how can we give them access to financial services and ensure that the financial services of the future is really reaching out to every single one in society, not just the people who can have perhaps the funky colored card. In emerging markets, Africa, India, we have seen this done from smartphones, we've seen it done through digital ID. And I think it is time to build back better through that technology, looking at it through a lens. Not every solution is the same for every single consumer. But if we don't embrace technology, we're constantly going to be trying to stay ahead of our EU competitors. And actually, we have a real chance through the innovation and the amount of financial services companies we have across the UK to springboard us to that next new level.
Thank you very much. Rachel, can I ask any of your kind of opinions on things you've heard? I suspect you may have a take on the quote from Charles from his bank of contact about the being past equivalency. Anything else you may have an opinion on as well?
Well, I was going to start by thanking Vincent for the history of the City of London. It doesn't matter how many years I work there, I still learn something new. So the Lombard Street was certainly new to me. I mention that because it just made me think, in that very long history, how many challenges must the city have faced? Certainly, I'm sure the people on this panel have joined it in facing a few of them. And I really passionately believe it will continue to reinvent itself, perhaps even the urgent recalibration that Xavier spoke about. But you should just be in a room with the FinTech community at the moment when you throw a problem at them. Financial inclusion, CBDC, digital ID. They believe they can solve those things. I believe them, and it sounds a bit like Charlotte, you do too, probably because we're in the same room. But I think the thought I just want to leave you with is that last week, possibly the week before, JP Morgan announced the launch of its first ever digital retail bank outside of the United States. That was in London. Not in Europe, in London 2 weeks ago. So I think that's, I hope that bodes very well for the future, whatever the banker said.
Thanks very much. Vincent, any thoughts from you? And I'd like to throw a question your way as well from somebody watching. Jim Bly asks, how does the panel, and I'll put it to you first, see the future of work in the city after you've talked about the sense of place and offices and things like that? Will offices snap back? And I suppose if yes, what's the one thing, and maybe the rest of the panel will have a take on this as well, a benefit of the more work from home culture that you would like to see carry on when the world comes back to normal?
Sure. On the general comments about, I very much agree with Xavier's comments. We need to find a way of breaking through some of the barriers that exist at the moment, and the pools of capital out there, actually making sure that they are being tapped and accessed by the SME community, and allowing the growth capital to come through. And I think there is a possibility that we are at the moment to in terms of making that happen. We've got a recapitalization crisis coming as well post-COVID. A lot of businesses are facing a real issue in terms of recapitalization after the crisis. So I think if we can take those two challenges together, there is an opportunity to break through some of the log jams, the regulatory stasis that has prevented some of what we all agree, I think, is necessary. It sounds as if there's a fair degree of consensus in the panel on this, that we may have a moment here to push some of those changes through for once. And Lord Hill's report and Ron Khalifa's report, I think, will all add ammunition to our arguments in that respect. On the office, I'm a firm believer, as I said in my previous remarks, I'm a firm believer in the future of the office, but it will absolutely be different. I think one of the challenges will be who's going to be in the city on a Monday and a Friday. I think that is, like, all of us. I can see Rachel nodding, and I think certainly any professional services firm is trying to work out how we are going to staff the office in any meaningful way at either end of the week. What we've learned, we can do an awful lot remotely. What is missing is that person-to-person interaction, and we are seeing now. The third lockdown is very tough. We are seeing significant mental health issues across the sector. I was on a call yesterday with the Samaritans and hearing just how extraordinarily busy the Samaritans have been over the last several months, particularly over this period of the third lockdown. So people need that interaction, that one-to-one contact that they get from being in the office. It will come back. But it will feel a bit different. It will feel a bit different too, and we're just going to have to work out some of the practicalities of this over the next year or two.
Thank you very much. And lastly, Charles, any thoughts you may have? Your comments at the end of your opening remarks have a little bit of a tinderbox in some of the replies from other people on this panel. And I wonder as well if you could just talk a little bit about exactly what Vincent said there about the challenges of running a company as you do, and the challenges of lockdown and what things will look like when we get back to normal.
Yeah, I mean, the thing about investment bankers is that they're very prone to making sweeping statements. But it was meant seriously, though I appreciate it's not a shared view. In terms of office, the office question, I think that in a year's time, those people who will be back in offices will be saying, I don't know why working from home was such a great thing. And as a businessman, the approach I take is that you only do business by being in the room. And I think there'll be Zoom exhaustion and Teams exhaustion, and I completely agree with Vincent's point about the mental health crisis that is unfolding, particularly amongst young millennials who are spending too much time on their own at home. If I just make one final point about the European Union, I thought it was really interesting, and I think he was completely correct when Xavier said it's going to take us a long time before we get any kind of agreement with the European Union around different disciplines or branch by branch. So I think this is why a lot of people in government are saying, why try and why wait? And I think the other interesting development as a result of last weekend was that this sort of peremptory, knee-jerk, bureaucratic response by the European Union over Article 16 and the distribution of vaccine across Europe has just reminded the politicians of what being a third country is all about outside the European Union. And actually, if the city wants the government to spend a lot of time negotiating equivalence, the question that they're already asking is it going to be worth the candle if we're just going to be treated like Switzerland and the rules will be changed at a week's notice? So I think that there's a lot of moving parts around all this. Final observation is that the structures that most fear disruption are always the biggest, because they have a large market share and they worry that disruption will mean that they'll lose market share. The best big businesses that face disruption move quickly to accept that change is coming and respond to it. And I think if the city does that, we will maintain our preeminence for many years to come.
Charles, thank you very much. I'm struck by something that Lord Miners said in his opening remarks, that he wouldn't recommend someone going down the same path that he's gone down, that he went down himself. And considering there are so many people watching and who will be watching this when this video goes out to our 1 million+ YouTube subscribers as well, who will be students who will be wondering what to do with their lives and will be wondering whether they should stay in academia, whether they should move abroad, whether they should move to the city. I was wondering if I could just ask everybody in turn for a piece of career advice for everybody watching, and I think most of your remarks have been why people should come to the city, but whether that is indeed the advice that you would give. So Lord Miners, very quickly, could I just ask you for the bit of career advice for the people, our members who are watching?
I would go into data, quantum computing, health science, and Africa.
Puts my my humanities degree slightly to the shame there. That's a perfectly succinct response. Thank you very much. Xavier Rille, can I ask you the same question?
My son is studying biology at Oxford University and Yale, and I'm not dissuading him from that particular path. I concur with Lord Miners that Africa is a place to look at. The Global Cities Institute in Toronto University estimates that by 2050, 15 of the world's largest 20 cities will be in Africa. Only one will be in China, by the way, none in Europe. Lagos, they expect there will be a city of 77 million people. So if you're looking for growth, and London, I think, is well positioned. But communications, I think, is also critical. And sorry to make this a little personal, but my son is actually doing a double major studying film studies. I do think that communication is going to be very important. And again, Lord Miners said something very wise. We're right at the edge of plunging into a whole new world of technology with the advent of quantum computing, quantum communication, teleportation. And that, I think, will be the true technological revolution, that it is going to turbocharge the power of artificial intelligence, the power of internet, things that we have not seen. And this is an area definitely where the UK is not doing too badly. So let's make sure these companies and entrepreneurs have the finance, which means there's still opportunities for those of you who are looking to fund these innovative businesses. Maybe there's still a few things to do, although they might not necessarily be in London. Thank you.
Thank you very much. Charlotte, the same question to you.
I think just don't think of financial services probably as a stereotype of what financial services has been. Look at what financial services can become. And that's anything from the high street bank to the investment banking to OTC derivatives that Xavier has been talking about. Think about financing green, think about financing innovation, think about working in entrepreneurship and innovation. We are seeing incredible support for that. And I think from what I've seen across all of the UK universities, the drive to support that entrepreneurship, to create now what's going to probably be a virtual network like Silicon Valley, gives that opportunity to come in and try something. There's so many career choices you're going to make. I did a 2-2. I got a 2-2 in French, and I spoke fluent French. And guess what? I've worked in finance, I've worked in tech and everything else. So your first decision won't be your final decision, but to go and do something you feel passionate about, where you see an opportunity, and go and make a difference.
Rachel, no surprise, same question again.
Charlotte just took the words out of my mouth. There's surely only one answer to that question, which is absolutely follow your passion and do what you love. I obviously went into the law and I love that. My brother went into data science and he loves that. If we'd got that the wrong way around, we'd both be very unhappy people. If you can find happiness in it, absolutely take the roles Lord Minor's mentioned. I think they sound fantastic. My daughter is about to become a lawyer in the City of London. My son is studying history and wants to go into asset management. But I think the point I would make is that whatever of those things that have been described, there will be a place for you in the city.
Vincent, the same question to you.
Yeah, I have to say, Rachel's probably taken the words out of my mouth on this occasion. But yeah, the city is much what it's not just financial services. What it's really about, ultimately, what we want to do is to have a creative environment, an imaginative and innovative creative environment, and then that allows lots of things to happen. It even allows lawyers to be innovative and creative on occasions, which, believe it or not. So I think if you can hang on to that, if you can tap into that creativity and innovation, and be ready for change and flexibility, because there's going to be a lot of change, and we'll all need to be very flexible in the way we look at the world over the next 5, 10, 20 years.
Thank you. And Charles Vincent, I was tempted to throw you a completely different question there, but I think I'll stick with it and ask you exactly the same one.
No, data, quantum, life sciences. My daughter is a mathematician. She's just embarking on a career as a data product consultant. And I feel sure that in 10 years' time, she'll have made a lot more money than I've ever made in my life. I suppose the other thing I would say to anyone embarking on a career is think less about a career and more about an opportunity, and give Charlotte a call and she'll put you in touch with a good VC that it will provide you with seed funding, and you can be the next Jeff Bezos before you retire, that is.
Thank you very much. And thank you to everybody. Thank you to Miners, to Xavier, to Charlotte, to Rachel, to Vincent and to Charles. And thank you everybody for watching. As I said at the start of this, please tune in for some future events. Nimco Ali, I'm interviewing tomorrow, the anti-FGM campaigner. We have a debate tomorrow night that this house believes the NHS is the envy of the world. And hopefully you will see our panel walking around the wonderful streets of the City of London, whether they're the great big gleaming skyscrapers or the narrow streets that Vincent can tell you the etymology of their names. And everybody, thank you very much. Thank you to our panelists and have a wonderful evening.